in the financial sector. Usually something makes an all-time high, you overshoot by about 10%. Not exactly 10, but you get a rush of headlines, a rush of momentum, people looking at something for the first time. Look at that, it's going up, so we gotta buy some. So my goal was always 2,300. As it turns out, that's kind of a technical level for the rally as well, and that's why gold's kind of run into kind of a little bit of resistance there. Now, see what happens next. For gold to catch its breath a little bit, but it may not. I mean, it may just, if we think silver's going to, going to get into the 30s and rally from there, then the shares are going to take off too. So there's still plenty of time to get yourself positioned if you like the mining shares.
In today's show, Craig Hemke discusses the recent price action in gold and silver as precious metals are on the rise and most doubters are turning bullish. Hemke discusses his price predictions for 2024 in gold and silver and what he expects price to do in the short term. We'll also cover the most relevant news for the day as usual, like subscribe and turn on notifications so you do not miss out the best clips of the most sought after commodities experts. Enjoy the video.
Fundamental perspective, what a lot of analysts are kind of settling on as to why gold has chosen now to break out. I think it's more simple than that. You go back to the 1st of March. Okay, so we came out of February, prices had kind of struggled, or at least had bounced back from January. But on Friday, the 1st of March was the breakout day, where gold was up about $10. And then Goon Waller, I call him Goons, the Fed Governor Waller came out and gave a speech. He said, here's where I'd like to see policy go moving forward. I'd like us to shift from owning longer term to shorter term to bid down the short end of the bond yield curve. That would probably positively tilt the yield curve and then that's when a recession typically starts. But then he also intimated that once we do that, then we've got room to start QE again. Everybody went, whoa, wait a second. And gold shot up $30 on his comments that day to finish up 40, and began that month at the end, the 1st of March, with the highest weekly close that it ever posted. And what happened? You came in next week, everybody noticed that, and gold tacked on another $97 that first full trading week of March on this clear breakout because everybody noticed. What's interesting now is the trading week ended last Thursday because the markets were closed for Good Friday. So you had the weekend, the month end, and the quarter end last Thursday. And gold finished with what I call a superfecta, the horse racing term, where you get first through fourth. That day, Thursday last week, gold finished at its all-time daily high, all-time weekly high, all-time monthly high, and all-time quarterly high. So if you're going to generate some momentum, you get this breakout of the trading range a month ago. Now you end the month and the quarter at these all-time highs. This is where, the home offices, the hedge funds, the institutions all go, wow, something's going on here. I got to be a part of it. And so the thing kind of builds on itself. And that's what has happened so far. We can kind of maybe relate this into silver, which hasn't even broken out of its trading range yet. It's pretty clear what silver needs to do. Where gold, I just mentioned how gold had broken out at the end of February, and everyone, wow, look at this, all-time, new weekly highs and all that kind of stuff. And you had this big rush of momentum and excitement the following week. Silver hasn't done nothing of the sort. In fact, silver hasn't even posted a weekly close above 26 for over 2 years. And so you got to at least get that done. And we may get that done this week, provided we make it through tomorrow, okay? But the top of gold's or silver's breakout is actually 28. It needs to break out and close a week above 28 before it starts moving into the territory that gold now occupies on a clear breakout. So it will probably close above 26. That's the first step. And then we'll probably bang around. Who knows? Maybe we'll just fly through 28 next week and woo, that'd be great. But once we get above 28, then silver starts getting a life of its own the way gold has for the last several weeks. You start getting a 3 handle on your silver again for the first time since, 2012. And that's going to generate its own level of excitement. I'll remind everybody, and this is typically how it goes. I would extend this answer for a second, Elijah. The only other time I'd seen a superfecta in gold was on December 31st of 2010. And it finished at all those, even an annual high. Okay, at the end. And then, so then what happened? Gold finished that year at 1420. And by early September, put in that old all-time high of 1920. So what's that, a 20 some odd percent move, right? Well, while that was taking place, silver began 2011 at 18. And by, everybody probably recalls, by the 1st of May, it was 48. So it can go fast. I mean, it's not unprecedented to see it happen. But that, and again, this is important for people that think that, I've already missed out. You know, silver's up $2 in the last 4 days or whatever it is. Silver's got to get above 28 and then pick up a 3 before you really start getting into the fireworks. And we're not there yet.
In today's news recap, silver to ride coattails of gold's record prices. Silver has the most potential to benefit from a sustained rally in gold among the precious white metals, reckon UBS analysts. Silver has started to gather some attention in early second quarter following the relentless rally in gold to new all-time highs. With many investors caught off guard by the speed and magnitude of gold's ascent, silver has been offering market participants a chance to catch up. We think it is still early days, with silver's year-to-date outperformance still relatively muted compared with its historical behavior. Investment demand and green technology trends could help to drive silver's demand, UBS added, as could wider risk-on sentiment in the wake of interest rate cuts, while higher volatility is likely to also attract more active investor participation. Now we'll show you more clips of the latest Hemke's interview. Like, subscribe, and share this video with a gold bug to support the channel. Let's get back into the video.
Anytime you get into a longer term or even just a shorter term bull market, where you've got an extended run up in prices, under this pricing scheme, where the price you're seeing is primarily derived through the trading of, derivatives, futures contracts, you get this rush of speculative money that comes in and open interest expands and everybody's buying the contracts and the price goes up. Well, eventually you get to a point where all that buying gets exhausted, at least temporarily. And price begins to roll over. Some of the latecomers go, hey, I'm going to ring the register on this. And they start selling those longs that they just bought the week before, or the day before, or whatever. And you get a correction and a pullback. And that money washes it back out. And then you stabilize, but the trend is still up. And then you charge forward again. That's just how it works. I mean, we call it the, a wash and rinse cycle, if you will. 2 steps forward, 1 step back. And I just can't imagine that it's not going to continue that way. I mean, we could wake up Monday, right? And all of a sudden China says, hey, we are a buyer of gold at $5,000 an ounce. And then all of a sudden we go to $5,000 an ounce. More likely, at least given how it's always gone in the past, this to the moon stuff is not how it works. Okay, we're not going to 3,000 by the 4th of July. We're not going to $100 silver, all these things that people have been banning about now that there's some interest in the metals again. You go up, you'll consolidate, you'll pull back, move up higher, come back down, move up higher. That's typically how it works. So silver now it's above 26, probably touch 28, kind of pull back, and then we'll see if it can generate enough fresh momentum. I remember when we spoke at the end of last year, and I said, oh man, I'm a little worried here because the market has really gotten ahead of itself. I mean, when we wrapped up 2023, the Fed was talking about 3 rate cuts and the market was pricing in like 7 or 8. So as we went into the first quarter, I thought, well, this is going to be kind of tough sledding as this kind of, washes out some and comes back to earth. It's exactly what happened. The market's now anticipating 2 or 3. The yield on the U.S. 10-year note's gone up by 35 or 40 basis points in the first quarter. The dollar index has rallied 3%. You would have thought the metals had gotten slaughtered, but gold was up 8% in the first quarter and silver was up 4 or 5. So the fact that we've been able to weather that and still rally, that's an interesting part of this equation too. Now, I'll tell you one thing people should really watch, whether it's, as we record this tomorrow, Friday, April the 5th, is the next jobs report in the U.S. The first Friday of May will be the next jobs report after that. Powell made it very clear, and I heard him say it in his press conference 2 weeks ago after the FOMC meeting. He stated that he will be watching the unemployment rate very closely, because if he sees that ticking up, he will prompt the Fed to act preemptively to cut rates, because he's afraid of acting too late. He said this again yesterday in his speech at Stanford. If we wait too long, the damage could be great, is what he usually says. So he's watching the unemployment rate really closely. Last month, it ticked up from 3.7 to 3.9. It's all part of what really got gold going that first week of March. So watch this now. It wasn't just a one-off either. Powell then that following weekend, which is now 2 weeks ago, in an interview with Bloomberg, said the same thing. Inflation will have to take a back seat. If we start getting weakness in the labor market, we're going to put the inflation fight on hold, and we're going to lower Fed funds to try to counter that. I mean, he's on the record saying this. So let's watch that unemployment rate, both this Friday and then again the first Friday in May, because having come all the way down, and maybe now the market is anticipating even less rate cuts than what the Fed is saying. If all of a sudden rate cuts for June or whatever are back on the table, that could have a positive impact on the precious metals.
What's your opinion on Hemke's take? Will gold have a consolidation phase, or will it continue to blast through new highs? Post your price prediction for gold and silver in the comments section, and watch this video right here because it's a perfect fit for you.